Stop. Just stop. Take your hand off the mouse. Close the tab with your 14 different custom indicators. Delete the Holy Grail strategy video you were about to click on next. You are losing money. And if you are being honest with yourself and if you want to be in the 1% of traders who actually survive this game, you know exactly why. You aren't losing because the market is rigged. You aren't losing because your internet connection lagged. You aren't losing because of some black swan event. You are losing because your entries are garbage. You have been lied to. From the moment you opened your first broker account, you were fed a narrative. You were told that trading is about prediction. You were told that if you find the right combination of RSI, MACD, Fibonacci retracements, and volume oscillators, you will finally solve the market. You were told that the goal of a trade entry is to buy the absolute bottom or sell the absolute top. That is the big lie. It is the single most expensive myth in the history of finance. And today, here at Jesse Livermore's Trading Academy, we are going to bury it. Welcome back. I am your host, and today we aren't talking about indicators. We aren't talking about signals. We are talking about the reality of the tape. We are going to dismantle everything you think you know about how to enter a trade, and we are going to replace it with the only mindset that has ever created generational wealth, the 1% trader mindset. Visual. Transition to a high-contrast graphic with the channel logo. Jesse Livermore's Trading Academy. Let's be real about what happens to you every single day. You see a setup, your indicators line up. The Bollinger Band is squeezed. The RSI is oversold. Maybe you even see a bullish engulfing candle on the 5-minute chart. Your heart rate spikes. You feel the adrenaline. You click buy. And what happens? The market pauses. It teases you. And then snap. The market rips in the opposite direction, hit your stop loss, and leaves you staring at your screen in disbelief. You feel like the market is watching you. You feel like the algorithm knows exactly where your stop is. Here is the truth. The market doesn't know you exist, and it doesn't care. The problem isn't the market. The problem is your definition of an entry. You are viewing an entry as a point in time, a specific price coordinate where you pull the trigger. You are obsessing over where to get in. But the masters, the men who built it, empires like Livermore, they don't obsess over where. They obsess over why. Let's talk about the big lie in detail. The industry sells you precision. They sell you the idea of the perfect entry. They want you to believe that there is a secret algorithm or a golden ratio that will put you in at the absolute bottom of a move. Retail traders operate on a philosophy of, I hope I'm early. You want to catch the move before it happens because you're terrified of missing out. You are obsessed with the dip. You are obsessed with buying the support. But ask yourself, when you buy at the support, what are you actually doing? You are stepping in front of a freight train. You are betting that the selling pressure is exhausted. And when you are wrong, which, statistically, is most of the time, you get crushed. Jesse Livermore, the greatest speculator of the 20th century, never tried to buy the bottom. He never tried to sell the top. He famously said, "It never was my thinking that made it. The big money for me. It was always my sitting." Think about that, sitting. He didn't wait for the exact price. He waited for the confirmation that the path of least resistance had changed. When he entered a trade, he wasn't guessing that the market was going to turn. He was reacting to the fact that the market had turned. The big lie is the belief that trading is about being smarter than the market. It's not. Trading is about being humble enough to let the market show its hand first. When you focus on the entry point, you are fighting the market. You are imposing your will on the chart. I want it to go up here, so I will buy here. When you focus on the market condition, you are working with the tape. You are waiting for the market to tell you, the door is open. Most of you are trying to pry open a door that is locked, bolted, and barricaded. You see a slightly bullish candle, and you assume it's a breakout. But is it, or is it just a liquidity grab to trap bulls before a pit? Massive liquidation? If you don't know the difference, you are not a trader. You are a gambler playing a game of chance against institutions that have better data, faster execution, and unlimited patience. In the next part of this deep dive, we are going to tear down the mechanics of the 1% entry. We are going to move away from these lagging indicators that tell you what happened 10 minutes ago. and we are going to look at the only indicator that actually matters, the tape. But for now, I want you to sit with this realization. The pain you feel when you get stopped out, that isn't bad luck. That is the market correcting your ego. You think you are entering a trade. The market thinks you are providing liquidity for the smart money to exit. Every time you click buy at a support level because it looks cheap, someone with a terminal 3 times the cost of your car is on the other side of that trade, smiling. They are waiting for you. They need your stop loss to fuel their position. Are you tired of being the fuel? Are you ready to stop gambling and start speculating with the cold, calculated precision of a legend? If you are, then you are in the right place. But understand this. What I am about to show you in the coming segments isn't easy. It's not a get-rich-quick scheme. It is a philosophy of discipline, patience, and absolute brutality. We aren't here to make a quick buck. We are here to build a career. We are here to change the way you see every single tick on that screen. If you're ready to fix your entries, to stop the bleeding, and to start reading the market the way Jesse Livermore did, not as a series of numbers, but as a living, breathing entity driven by greed, fear, and human nature, then hold your ground. This is not a game for the impatient. This is a game for the masters. We are just getting started. Are you with me? You've accepted the lie. You know now that your obsession with perfect timing is the exact mechanism that creates your losses. You aren't playing the market, you are playing a game of chicken with a freight train, hoping it stops exactly where you stand. It won't. It never does. Today, we peel back the layers of the 1% trader mindset. We aren't talking about indicators. We aren't talking about RSI settings or MACD crossovers. We are talking about the philosophy of the speculator. Jesse Livermore, the boy plunger, didn't have access to your Bloomberg terminal. He didn't have a 1 millisecond execution feed. He had a ticker tape, a pencil, and a mind that understood human nature better than any algorithm ever could. The core of the 1% trader mindset is this: the market is not a machine. It is a reflection of human emotion. When you look at a chart, you are not looking at price action. You are looking at fear. You are looking at greed. You are looking at the collective hopes and terrors of millions of participants. If you try to analyze the chart mathematically, you are trying to solve a poem with a calculator. You will fail. The first rule of our academy, and the cornerstone of Livermore's success, is the concept of the path of least resistance. In the natural world, water flows downhill. In the market, price flows where the pressure is lowest. If the market wants to go up, it will. If it wants to go down, it will. It does not care about your support levels. It does not care about your key Fibonacci levels. If the institutional money decides to flush the market, your Fibonacci level is nothing more than paper in a hurricane. You must learn to stop predicting and start observing. Most traders wake up in the morning and decide, today, I am going to be a buyer, or today, I am going to be a short seller. That is not trading. That is bias. A 1% trader wakes up with no opinion. He sits on his hands. He watches the tape. He waits for the market to reveal its intent. He looks for the pivot point. What is a pivot point? It is not a magical line drawn by a black box indicator. It is the moment in time when the path of least resistance changes. It is the moment the market confirms that the previous trend is dead and a new trend has begun. Most of you enter before the pivot. You try to guess the change. You get into the trade while the market is still trending against you, telling yourself, it's oversold, it has to bounce. That it has to is the bankruptcy of your account. Nothing has to do anything. The 1% trader waits for the pivot point. He waits for the market to break the trend, retest the level, and prove with volume, with conviction, with aggression that the direction has shifted. He misses the first 5% of the move. He doesn't care. He catches the 50% that follows. This is the hardest thing for a retail trader to accept. You want the whole move. You want the bottom to top capture. You think that's how you get rich. Let me tell you the secret. The middle of the move is where the money is made. The top and the bottom are reserved for liars and fools. If you want to be a 1% trader, you must divorce your ego from your trade. Why do you struggle to cut losses? Why do you move your stop loss further away when the trade goes against you? Why do you average down on a losing position? It's ego. You feel that if you admit the trade is wrong, you are wrong. You feel that if you take a loss, you have failed. The 1% trader views a loss as an operating expense. Imagine you own a bakery. If you buy flour and it turns out to be spoiled, do you keep it? Baking bread with it because you paid for it? Number. You throw it out. You take the loss on the flour and you buy better flour. In trading, a stop loss is simply throwing out the spoiled flour. When you get stopped out, it isn't a judgment on your character. It isn't a sign that you are a bad trader. It is a signal that your thesis was wrong. You adjust, you recalibrate, and you wait for the next pivot point. But you cannot wait if you are emotional. You cannot wait if you are married to your position. This is why we talk about the 1% trader mindset. It is the mental resilience to act like a cold, calculating machine in the face of adrenaline. In Livermore's era, the ticker tape was the source of truth. Today, you have more data than you could ever process. And yet, you are more confused than ever. Why? Because you are drowning in noise. You are listening to the news. You are watching the influencers on Twitter. You are reading the macro outlooks of people who have never traded a single contract in their lives. Stop it. The news is designed to induce emotion. The news is designed to keep you glued to the screen, panic buying and fear selling, providing the liquidity that the institutions need to manipulate price. If you want to enter the 1% of traders, you have to cut the noise. You have to focus on the price action. You have to understand that the price is the only thing that doesn't lie. The price is the truth. The price is the summation of all news, all rumors, geopolitical events, all sentiment. If the price is going up, the buyers are more aggressive than the sellers. That is all you need to know. Stop asking why the market is moving. Start asking what the market is doing. In our next segment, we are going to dive into the technical meat of this. We are going to look at the anatomy of the entries that actually work. We are going to look at how to identify those pivot points, how to wait for the confirmation, and how to execute with the surgical precision of the institutional elite. But before we move on, I want you to look at your trading journal. If you haven't been keeping one, start today. Write down this question at the top of the page. Am I waiting for the pivot, or am I gambling on a guess? The difference between those two answers is the difference between a lifetime of frustration and a career of freedom. The market is an endless game of cat and mouse. Most people are the mouse. They are scurrying around, terrified, looking for scraps. We are not mice, we are the cats. We watch, we wait. And when the moment is right, we strike. Are you ready to stop scurrying? Are you ready to start waiting? Then keep this discipline. Do not rush. The market will be here tomorrow. The opportunities will be here. Your capital, however, is finite. Protect it. We are building the 1% trader. The foundation is set. Now, let's build the structure. Most traders are living in a fairy tale. They believe that if they draw a horizontal line across the top of a chart, a resistance level, and the price crosses it, that is a signal to buy. They call it a breakout. And for a few fleeting moments, they feel like geniuses. Then the reversal comes. The price slices back down, stops them out, and continues in the opposite direction. Why does this happen? Is it bad luck? Number. It's because you are trading a retail breakout. You are trading the exact setup that institutional algorithms are programmed to punish. Today, we move beyond the fairy tale. We move into the technical architecture of the market. If you want to trade like the 1%, you need to understand the concept of institutional liquidity. The market is not a fair playing field. It is a game of liquidity. Large institutions, banks, hedge funds, sovereign wealth funds cannot just buy a stock or a currency pair. They have massive orders that would move the price against them if they executed all at once. They need a deep pool of other traders to buy from or sell to. Where is that liquidity found? It is found exactly where your textbook trading strategy tells you to put your stop loss. When you place a buy order because a resistance level broke, you are providing the liquidity for the institutions to sell. You are the exit for their short positions. So, how do we stop being the liquidity and start being the shark? We use the three-step entry protocol. This is not a magic indicator. This is the study of how price moves to create a pivot point. Step 1. The liquidity sweep, the stop run. Before a trend can actually move, it must clear the weak hands. You will see price move rapidly toward a known support or resistance level. Retail traders see this and think, it's breaking, I have to get in. They enter, they put their stop losses just past the high or the low. And then the institutional, smart money pushes the price just far enough to hit those stop losses. This is the liquidity sweep. It is the violent wick that you see on your chart. Most people look at that wick and think, it was a false breakout. A 1% trader looks at that wick and says, thank you. The institutions have just filled their massive positions by eating the stop losses of the retail herd. The market now has a clean slate. The weak hands are out. The path is clear. Step 2. The market structure shift, MSS. After the liquidity sweep, you do not buy immediately. You wait for the market structure shift. You are looking for the price to aggressively break the previous short-term high or low in the opposite direction of the sweep. If the price swept the lows, a stop run to the downside, you are waiting for it to rip upward and break the most recent lower high. This is the confirmation. This is the market telling you, I have finished collecting liquidity, and now the trend has changed. This is the pivot. This is the moment the path of least resistance has tilted in your favor. Step 3. The retest, fair value. This is where the amateur fails. The amateur sees the market structure shift and feels FOMO. It's running. I need to buy now. Number. You wait for the retest. The market always leaves a footprint. After a violent expansion move, the market almost always returns to fair value, the area where the initial move started. You place your limit order at this retest zone. You are entering with the trend, you are entering at a discount, and you are entering at a discount, and you are entering after the institutional hand has been shown, the contrarian view. Why? Breakouts are dead. I know what you're thinking. But I see traders online making money on breakouts. Yes, they make money on the obvious breakouts. The breakouts that happen during high-volume news events or during high volatility sessions where the trend is undeniable. But for every one of those, they lose on 10 fakeouts. If you are a breakout trader, you are a momentum trader. You are betting that the trend has legs. If you are a 1% trader, you are a reversal and continuation trader. You are betting on it. The failure of the breakout. When you see a resistance level being tested for the 4th or 5th time, the retail trader sees strength. The 1% trader sees a liquidity trap. We don't buy the breakout. We wait for the breakout to fail. We watch the stop runs, and we enter as the price moves away from the crowd. This is the psychological edge. It requires you to do the opposite of what your brain is screaming at you to do. When the news is bullish, when the charts look like they are breaking it out, when everyone on Twitter is screaming, buy, 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 that is when you should be preparing to look for the failure. Because where is the liquidity? Where are the stops? If everyone is a buyer, there is no one left to buy. The market is exhausted. This brings us to the most critical component of the Academy's philosophy. We have the entry strategy. We have the understanding of the institutional hand. But a great entry is worthless if your risk management is garbage. You can have the best entry in the world. You can enter at the absolute bottom of a move, but if you leverage yourself 50 to 1 and put your stop loss in the wrong place, you will still go to zero. The entry is only the beginning. The trade is managed by how you handled the risk. In the next part, we are going to dissect the 1% discipline. We are going to talk about position sizing, the psychology of taking a profit, and the brutal truth about how to keep your capital when the market tries to take it from you. Do not think for a second that this technical setup makes you safe. Safety is an illusion. Your only protection is your process. Are you taking notes? Are you mapping this out on your charts? Because I'm going to tell you something that most gurus won't. You don't need 100 strategies. You need one strategy mastered to the point of boredom. If you find yourself excited while you trade, you are doing it wrong. Trading should be boring. It should be repetitive. It should be the execution of a predefined plan. We are almost at the finish line of this deep dive. We have the mindset. We have the technicals. Now, Let's talk about the survival. Are you still with me? You've learned the entry. You understand the liquidity sweep. You know how to wait for the market structure shift. You have the technical tools of a predator. But I am going to tell you a brutal truth. If you ignore what we are about to discuss, you will lose every penny you have. There is a statistic that haunts the retail trading world. 90% of traders lose money within 90 days. Why? Is it because they don't know how to draw a chart? Number. It's because they don't know how to survive. They treat trading like a casino. They go all in on a hunch. They ignore their stop losses. They double down on losers. They are gambling. We are not. We are running a business. The 1% trader understands one fundamental reality. The market is designed to kill your account. Your job is not to make a fortune on one trade. Your job is to stay in the game long enough for your edge to play out. This is the 1% discipline. The myth of the high win rate first. Let's destroy your ego regarding your win rate. You spend hours looking for a strategy that hits 80%, 90% of the time. You think that if you win 9 times out of 10, you are a master. That is the mindset of a beginner. A 1% trader knows that win rate is a vanity metric. You can have a 90% win rate and still go bankrupt. How? Because if you risk 10% of your account on every trade to make 1% profit, which is exactly what happens when you let your losers run and take your profits early, you will eventually hit that one massive loss that wipes out every single gain you ever made. This is the math of ruin. The only metric that matters is your risk to reward, R to R ratio. If you risk $100 to make $300, that is a 1 to 3 ratio. If you do that, you only need to be right 30% of the time to be profitable. Do you understand the freedom in that you can be wrong 70% of the time and you are still printing money? When you stop trying to be right and start trying to be profitable, your entire psychology changes. You stop fearing the loss. You welcome it. A loss is just the cost of doing business. It is the commission you pay to the market to participate in the game. Position sizing. The formula of longevity now. Let's talk about the mechanics. How do you ensure that one bad trade doesn't ruin your career? You use position sizing. Most traders look at a chart, see a move, and put on a position size that feels right or big enough to make a good profit. That is emotional sizing. That is suicide. Your position size should never be determined by your greed. It should be determined by your risk per trade. Here is the golden rule of the 1% trader. Never risk more than 1% of your total account equity on any single trade. If you have a $10,000 account, you risk $100. That's it. If your entry point is at $100 and your stop loss is at $95, your risk per share is $5. To risk $100 total, you can only buy 20 shares. Do you see the difference? You aren't guessing. You are calculating. When you limit your risk to 1%, you can survive a string of 10, 20, even 30 losses in a row. It would take a catastrophic, statistically impossible sequence of failures to blow up your account. This gives you something most traders never have: emotional detachment. When you are only risking 1%, you don't sweat the wiggle. You don't stare at the screen heart pounding, praying for the price to go up. You know that if you are wrong, you lose 1%. That's all. It's an annoying loss, but it's not a life-changing disaster. This is how you maintain the mental clarity to follow your plan. The psychology of drawdowns. Even with perfect risk management, you will face drawdowns. You will hit losing streaks. It is inevitable. The amateur lets the losing streak destroy his confidence. He starts changing his strategy. He starts jumping from indicator to indicator. He starts revenge trading to make back the money he lost. That is the moment he seals his fate. The 1% trader treats a losing streak as a diagnostic tool. If I lose 3 trades in a row, I stop. I walk away from the screen. I go for a run. I read a book. I detach. Why? Because I know that my brain is compromised. I am currently tilted. I am looking to force the market to give me my money back. The market doesn't owe you anything. It doesn't know you lost money yesterday. It doesn't care if you enter the market in a state of emotional distress. You are a wounded animal and the market will eat you. When you hit a drawdown, your only objective is preservation. You reduce your size. You focus on execution. You wait for the A plus setup, the one that fits every single one of your criteria, not the maybe it works setup. You return to the discipline. You respect the math. You trust the edge. The 1% trader pledge. This is the secret sauce that the influencers won't tell you. They want you to think it's about secret indicators or AI bots. It's not. It's about being so disciplined with your risk that you become unkillable. If you are unkillable, you eventually win. It's a game of attrition. Most people quit because they go broke. If you never go broke, you never quit. And if you never quit, and if you never quit, you eventually master the tape. Are you beginning to see it now? It's not about predicting the future. It's about managing the present. We are almost done. We've covered the mindset, the technicals, and the risk. In our final segment, we are going to tie it all together into an actionable plan. We are going to talk about the 1% trader's daily routine and why your success depends entirely on what you do before the market even opens. But before we get there, I need you to do something. Look at your last 10 trades. Did you risk the same amount on every single one? Or did you go big on the ones you felt sure about and small on the ones you were hesitant about? If you went big on the sure things, you are gambling, you are guessing, and that is why your account is struggling. Correct this now. Standardize your risk. If you can't be disciplined with a $100 risk, you will never be disciplined with a $10,000 risk. The size of the account doesn't change the discipline. The discipline creates the size of the account. Are you ready for the final piece of the puzzle? We have been through the fire together. We started by tearing down the walls of your misconceptions. We exposed the big lie, the idea that trading is about prediction, that it's about being right, and that it's about catching the bottom. We burned that down. We replaced it with the reality of the tape. We discussed the path of least resistance. We mapped out the architecture of the trade, the liquidity sweep, the market structure shift, and the retest. We solidified your survival by installing the 1% discipline, the math that makes you unkillable. You have the map. You have the tools. You have the philosophy. But a map is useless if you don't know how to walk the path. Most traders think success happens during the golden hour of the market open. They think it happens when the bell rings and the charts start moving. They are wrong. Success is built in the silence. Success is built in the hours when the market is closed. If you want to be a 1% trader, you need a 1% routine. You need to treat your trading like an elite athlete treats their training. You don't see the gold medal during it. The race, you see the result of the 4 a.m. alarm, the strict diet, and the repetition of the craft. Your trading routine must be just as rigid. The 1% daily routine. 1. The pre-market scan, the no opinion phase. You sit down before the open. You have no position. You have no bias. You clear your mind. You scan the high volume assets. You identify the key levels, not to trade at them, but to watch how the market reacts around them. You are looking for potential liquidity sweeps. You are looking for the trap areas. You write down your if/then scenarios. If the price sweeps this high and rejects, then I look for a short. If the price holds this low and breaks structure, then I look for a long. You are writing a script for the market to follow. If it doesn't follow your script, you don't trade. Period 2. The execution, the boring phase when the market opens, you do not feel the market. You watch the market. You watch the market. You are waiting for the setup to come to you. This is the hardest part. You will feel the urge to click. You will feel the fear of missing out. That feeling, that is the amateur within you trying to take control. Ignore him. You are looking for the confirmation. You are looking for the pivot point. If the market gives you the signal, you execute with mechanical precision. If it doesn't, you keep your cash. A trader who makes no trades on a volatile day is often the smartest trader in the room. 3. The post-market review, the growth phase. This is where the transformation happens. You open your journal, not a digital spreadsheet, not a generic app. A journal where you document why you entered, why you exited, and most importantly, what you felt. Did you get impatient? Did you move your stop? Did you size up because you were sure? You write it down. You confront your own demons. If you do not review your trades, you are repeating the same mistakes over and over, expecting a different result. That is the definition of insanity, the lonely path. The academy here is the truth that nobody talks about. Trading is a lonely pursuit. You sit in that chair, staring at those screens, and when you win, you have no one to celebrate with. When you lose, you have no one to vent to. Your family doesn't understand the stress. Your friends think it's gambling. You are isolated in your own head, battling the most dangerous opponent you will ever face, yourself. That isolation is where the 1% trader is forged, but that isolation is also where the average trader breaks. I founded Jesse Livermore's Trading Academy for a reason. I didn't build this to sell you signals. I didn't build this to give you a get rich quick indicator. I built this to create a brotherhood of discipline. I built this to surround you with the kind of people who understand that trading isn't about the money, it's about the mastery. It's about the pursuit of excellence. It's about being able to sit in a room alone in the face of chaos and remain completely, utterly calm. We are building a culture of accountability. In the academy, we don't talk about price targets and moonshots. We talk about process. We talk about the tape. We talk about the tape. We talk about the discipline required to execute the strategy we have dissected in this series. If you are tired of the noise, if you are tired of the scams, if you are tired of losing money to the institutions because you refuse to change your approach, then you are ready. You are ready to leave the 99% behind, the final word. Everything you know about trading entries is wrong. But now, you have the truth. You know that the perfect entry is a trap. You know that liquidity is the fuel. You know that the market is a reflection of human psychology. You know that the only thing that stands between you and your goals is your own inability to follow your process. The market will open tomorrow. The candles will print. The liquidity will be swept. The pivot points will form. Will you be the one providing the liquidity, or will you be the one capitalizing on it? The choice is yours, and it is a choice you make every single time you sit down at your desk. I want to see you inside the academy. I want to see you hold yourself accountable. I want to see you take that journal, fill it with lessons, and build a career that lasts a lifetime. This journey isn't a sprint, it's a marathon, and you have barely started. But you've started with the right mindset. You've